Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi.
Okay, Imogen, we're going to start in the UK. Where else could we start this week? Because it has just been endless drama. And I'm sure that you're still buzzing with, I'm not quite sure whether it's just adrenaline or euphoria or whatever it is that I know. I'm not quite sure if euphoria is the right word, but I think that you've all been giddy with the intensity of it all. So now I guess the first question for me to direct at you is, what has been going on this week?
Well, yeah, for anyone who has had their head buried in the sand this week, there's been a lot of political noise out of the UK, and without running it through a kind of blow-by-blow account and telling you how many times I've refreshed my Twitter timeline this week, the essence of it is that Boris Johnson has now resigned as Prime Minister, having lost a huge amount of ministers over the first couple of days of this week. He has now resigned, and a leadership contest is underway, essentially. We will find out more next week on the exact timeline for that leadership contest for the leader of the Conservative Party. Until such time, he will remain as Prime Minister, although that feels a little bit up in the air right now, as he's clearly not the most popular minister, should we say, but that's where things stand at the moment. There's been a lot of volatility, a lot of news. The news flow has been very fluid, so I'm well aware that things could change even by the time we get this podcast out, but that's where we are right now as of Thursday afternoon.
Okay, so bringing it back to markets, I suppose, what does this change for the Bank of England, do you think?
So I guess for markets, the kind of key takeaways are that this increases the chances of early elections, and as a kind of byproduct of that, I think this increases the degree to which we might expect fiscal slippage, and perhaps brings that fiscal slippage earlier, perhaps as soon as the autumn budget, if not before, rather than later. So, at the margin, I think that this implies that you may well see slightly higher rates across the curve, but certainly I guess it gives the Bank of England a little bit more space to raise rates further. We've actually updated our bank rate call this week, and it's not just about the political development, it's also about kind of the strength of some of the data that we've seen over the last couple of weeks. But where our base case was for just one additional 25 basis point rate hike this year in August, and then we had two more rate hikes, 25 basis points next year in February and May. We've just brought those two kind of later rate hikes forwards by a quarter. So we now see one more hike this year and only one more hike next year, if that makes sense. And I think on the other side of the coin, because also, the Bank of England meeting in a couple of weeks, it's not just important from a bank rate perspective, but it's also the meeting in which they promised to come back to us on quantitative tightening. To the extent that, earlier elections and a change in government does actually imply, like I mentioned, further risk of kind of fiscal slippage, a bit more fiscal stimulus than we might have been expecting, and therefore, slightly higher gilt issuance than we might have had in our baseline forecast. I think that might just temper a little bit the extent to which the bank feels particularly kind of gung-ho about its plans for QT. So we didn't anyway expect sales to begin anytime soon. We'd already penciled in active sales not beginning until 2023. So we haven't pushed that date back at all, but we have slightly reduced the pace at which we think they will do those active sales. And listeners will know that we'd previously expected them to be at 50 billion of active sales a year, and we've just revised that down slightly to 35 billion.
All right, what does that all mean for markets then, Imogen?
Well, I'm going to sound a little bit like a broken record here, because I still think that the front end is pricing in much too much. We've had a big repricing over the last couple of weeks. So well, probably over the last 3 weeks. So we've definitely have spoken since then, but pricing for bank rate expectations by the end of the year have gone from about 190 basis points to 150 basis points. So we have had kind of 40 basis points of tightening priced out, but we still think that there's much further to go. You know, as I just told you all, our base case forecast is now for 50 basis points of tightening by the end of this year versus the market's 150 basis points. So there's a clear kind of 100 basis points we think of juice there to be priced out at the front end. So no change to the view when it comes to front end rates. I think for longer rates, you know, we have been bullish for a couple of weeks now. We set this target of 215. We kind of called the turn in the market at the right point, and you know, we said the peak was at 265, which is where it transpired to be, and you know, rates have been going the right way versus our forecast, although we didn't really expect the speed at which they have reached this 215 level. We put it on as a kind of summer target, and I think they got there within about 10 days in these kind of very volatile markets. But you know, everything that I've been saying about the fact that this adds, I think, supply risks to medium-term fiscal risks that already existed, just now I think is enough for us to switch marginally bearish again. And I say marginally bearish because, you know, I think there's offsetting factors like the fact that we think QT might be reduced slightly now, plus the fact that, you know, we still expect a big repricing at the front end, and that can limit how much higher longer yields can go. But I do think probably, you know, having gone through that 215 target, markets have now adjusted enough to these kind of growth concerns and the kind of fiscal supply slippage risks, and QT can now weigh a bit more on the long end. So we've updated our sort of near-term gilt yield target to 225, and I think that can rise closer to sort of 245 over the course of the next year. All right, that's probably enough on the UK this week then. And like I said, I'm sure something else will have happened by the time this podcast goes out. So perhaps we don't need to go into too much more detail on that. So over to you then, Giles. We had the ECB minutes today. Obviously, we've heard a lot from them since the meeting anyway, you know, and we've also had an ad hoc meeting since the meeting from these minutes. So perhaps you're going to tell me they were a little bit outdated and irrelevant, but did we learn anything new from them?
What I learn every single time is just how long the minutes are. Just identifying the important bits. I mean, you know, if you didn't have a word search function, I mean, where would we be? So, you know, there were some interesting things in there. I mean, there was some questioning about of the staff forecasts, you know, sort of inbuilt tendency to revert back towards the inflation target, and so, you know, a little bit of skepticism around that, you know, which gave it a little bit of a hawkish feel, I thought. You know, there was you know, a comment that, you know, the tightening implied at the time by the market wouldn't have, you know, was already kind of baked in the cake for the forecast, the staff forecasts, and therefore wouldn't necessarily be enough to bring inflation back down. And so, you know, the interpretation there would be that, you know, that was a call for an effort to try to increase what the market was implying at the front end. You know, there was a little bit of concern about the inevitable fiscal support still to come. You know, a couple of quantifications of the fiscal support that had all between 0.8 and 1%, so already reasonably significant. But yeah, that was there in the discussion, as it should be. You know, it's something that's important, and you know, we are also monitoring reasonably closely. And there was also some discussion of, at that point, at least, you know, according to the account of the minutes, some discussion of an anti-fragmentation tool, and you know, comments to the, you know, to where the sense of the comments were, you know, it would be in keeping with this idea of separation of different tools to do different things, if you like. So a broadly sympathetic discussion around an anti-fragmentation tool at the time, but clearly not the urgency to actually deliver the announcement, which we now know only took them a week of pretty extreme, severe stress to come out and make in their ad hoc meeting. But by and large, yes, you're right. It was a little bit dated.
Yeah, as is often the way, I suppose. So thinking a bit more about the present then, and what might have evolved since that meeting, we've obviously had quite significant euro weakness. How worried do you think the ECB may or may not be about this? And how might that translate into policy action or not?
Well, so this is an interesting and sort of fairly important question, because of course the euro has fallen by a solid 10% against the dollar this year, on the back of weakness last year as well. But 10% in 6 months, and it's a big move. But really that's been dollar strength. And so actually, if you look at the trade-weighted euro, that's only down. Well, I mean, it's down a reasonably small fraction of that, a quarter roughly. I mean, down sort of between 2 and 3%. So the question, I suppose, is what do they really focus on? And normally you would say they focus on the trade weighted, but actually I think that the dollar cross is arguably what they should be focusing on more, because if you think the trade weighted, it's about the overall mix of trade, right? But for inflation, really what matters is the supply side, and in particular energy, which we're increasing. So that's all billed in, largely billed in dollars, let's say, and obviously the component, we're buying a lot more, or the EU is buying a lot more gas from the US. Now that also will be in dollars. So I think that a reasonably large shock needs to be factored in here. And while the sensitivities generally are pretty low, so a 10% shock to trade weighted would be something like 0.3 on the sort of old estimates. But I think that that's probably higher in a high inflation environment. They're concerned about, because price shocks filter in more quickly and then broaden across the economy more quickly. So I still think that we might be, this might be a reasonable concern. I'm not saying that they'll be panicking over it, but I think it's definitely something that they will be worried about.
Fair enough. Bringing this back to bonds then, just in case any readers are worried, any listeners, are worried that we're straying too far off piece. We've had, another big week of volatility, and now I don't even know if we can keep saying that, because it's just become the new normal. But a big rally in fixed income generally, but in bonds, I suppose, is relevant for you. So what's going on there, and how do you see this playing out over the next couple of weeks?
I mean, I wish over the next couple of weeks, I don't know, but I suppose in the same direction that I would say over the next couple of months or the next couple of quarters, which is overall, I think from here, higher rates. That said, I expect the volatility, which actually today has been a rare sort of reasonably well-behaved day, but
I like that you're saying that in the context of a 10 basis point move in 10-year bonds right now. It's not that that's on your baseline.
Just look at the intraday charts over the last couple of weeks. Listen, I think the rates will actually continue to rise, and for most of the same reasons that I've been talking about for all year, really. I mean, I think the end of quantitative easing still matters a lot. I think that investors, despite their growth concerns, are not going to assume that we are we're going to go seamlessly back to a low inflation equilibrium anytime soon. On the contrary, I think that inflation uncertainty is still very high, and and overall, that is going to, it's going to mean more caution. So, and then finally, I think that the really hard choices for central bankers are yet to come. I mean, basically, they've all just been, they've been doing the obvious and easy stuff, which is sort of, relatively quickly moving interest rates back towards neutral in a reasonably benign economic environment. I mean, we're all worried about growth slowing, but it hasn't actually been slowing that dramatically, and we're certainly, I don't think anyone thinks we're now in recession. So I think they can always. So the question is, will they hit the brakes? Will they really see this through and make sure that they get a really good, strong deflationary recession or not? And I think that those are still questions that will weigh on investor sentiment. And I've already mentioned the fiscal side of things, which in Europe I think is as likely as in the UK to be an important part of the panorama in the second half, and arguably significantly more so than in the US. So maybe that's a segue to Jan.
Perfect segue into Jan. And actually, why don't we just kick off the US part of this podcast with a pretty similar question, Jan, because clearly this move in fixed income has been global. Treasuries have fully participated. What are you thinking about rates in the US from here?
I think, I'm going to end up overlapping a lot with what Giles said, but it was a very similar story where in the US there was a lot of focus on inflation, and now people took the idea that a recession is imminent and just ran with it. And listeners know we have been talking about kind of like our long conviction in treasuries, how we thought the sell-off was a little bit overdone, and the next step would be markets actually focusing on recession or an economic downturn. So that part is not really wrong. What we thought was a little bit overdone was the pace that it happened, because a momentum like that just requires at some point data to back those assumptions. We can't, like Josh, we can't just assume that we're already in a recession. We can't just assume that it's already a foregone conclusion, but that's how markets traded it. And as soon as there was almost no hurdles on the path towards lower yields, and then strong data came from services side, from job side. That's the JOLTS number I'm talking about. We will get the actual non-farm payrolls tomorrow, so I don't want to kind of talk ahead of that, which might completely make this irrelevant by the time that comes out. But that being said, data came stronger than expected, and yields flipped right back up, which is the reaction you would expect. So we still have a lot of sympathy with the view that the markets are going to increasingly focus on the recessionary risks as opposed to the inflationary risks, but that has to be supported by data. That, in our view, that has to be more of a grind towards lower, or kind of like finding a range in lower yields as opposed to snapping back lower and just everyone kind of jumping onto it, which kind of, that type of volatility exacerbates liquidity problems in the market, increased uncertainty, which even with lower yields could be hurtful for risk assets and such. But we're certainly not out of the woods yet, and that was pretty much what was going on with treasury markets. Just people took that idea and they realized that we need some data to actually back it up, and they didn't get that data yet.
So pushing you a little bit on the data, then I appreciate that we are recording this on Thursday, and so NFPs will come out, well, for us in the UK around lunchtime tomorrow, which nicely coincides with when we publish this podcast most of the time. So we may very quickly be proved wrong or right, but it's not just NFPs tomorrow. I suppose we also get inflation next week, and they're really the two key data points that the Fed will be watching. What's our kind of broad expectations for how they might sit versus the market, and then really what that does mean for the outlook for rates from there?
So I think the jobs part of the unemployment side of the economy is regaining a lot of traction. Until now, we've just almost exclusively focused on inflation, and now the question will be how much the Fed kind of caves into the view that economic downturn is slowing down. And if my read of the the semi-annual testimony of Powell's semi-annual testimony to Congress was right, the Fed has adopted a stance that they're willing to sacrifice growth. They're willing to overshoot in the direction of doing too much as opposed to risking doing too little a little bit again and letting inflation, become a little bit more unanchored or kind of increase at a similar high pace. I think that's the unacceptable scenario for them, even though the minutes, for example, didn't have a single mention of a recession, as a lot of headlines pointed out, even though they discussed that growth outlook was skewed to the downside, the risks to the growth were skewed to the downside. There wasn't really a kind of explicit worry that, the activity is about to come to a halt. That being said, I think it is right to assume that they're willing to sacrifice growth in order to contain inflation. So jobs will be important, but in my view, the unemployment, at least from unemployment side, it will be a little bit of a lagging indicator this time around, as there's been so much structural mismatch between hiring and unwillingness to fire people right away. So there's still a lot of dislocations within, sectoral dislocations that I still don't think will be resolved as quickly. So I wouldn't be looking to see, negative non-farm numbers right away, but more so look on the spending side of the equation, see if there's less demand from consumers to spend their savings on and income on services and such.
I know you kind of mentioned them already, but at risk of sounding very unimaginative in my questions and just asking the same to you and Giles, we obviously got the FOMC minutes this week. You did, like I say, just mention them. Was there anything else kind of within the minutes that is worth highlighting to our listeners, or that you think might be important for markets?
Unfortunately, no. And again, this repeats what Giles said, but it feels like a dated document now. It's not as timely because so much has changed. They've had plenty of press conferences since then. They had the semi-annual testimony that I just mentioned. So the message has been conveyed. There's a lot of uncertainty. July is going to be either a 50 or 75 basis point hike. We still lean towards 75, and market's not fully there yet. So there's an opportunity to capture if you believe that that's going to be the policy action they go with. But just really, it all came down to worries that inflation risks are still there, and they have to act, and they have taken the stance of we're willing to do more as opposed to we're willing to back out as soon as possible. So that's the main takeaway. And it would have been a lot to learn if we didn't have all this guidance in between the meeting and the minutes, but now it almost feels like a little bit of an outdated document.
Okay, that's probably a good place for us to leave that there then this week. Things are changing so quickly, not just here in the UK, but in global fixed income, in global markets really, that I'm sure there'll be plenty for us to talk about and catch up on next week. So thank you to all our listeners for joining us. And just a reminder that if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.